Good morning. Welcome to Trading with Larry. Unfortunately, Larry can't make it, but you're joined by myself. I'm Eric and Larry's right-hand man, Mr. Clint Brewer. How are you? And it was great to see you last week in Florida.
Yeah, it was a great time. We got to hang out in person and see everyone. So, but today you can take your boxing gloves off today.
That's right. No Larry, so I get to relax a little bit, right? No fighting on air. But you know what? for all the fighting we do, it definitely kind of gets that adrenaline going before the bell. Today we have a little bit of action before the bell, aside from Larry, with the belated jobs report, which just came out, and I think we can take a look at it. I'm actually of the mind that this is going to be an important one. So far, the reaction is incredibly positive, with bonds rising, which means yields are falling. Gold is up on the news, and the stock market, the futures are up on a jobs report that is showing us a 4.6% unemployment rate, which is a tick above the last reading. U.S. October non-farm payrolls at 105,000 month over month. Estimate was for a decline. So a good jobs number. Do you think it was real? I think that's the question.
I love how well, first of all, like when it comes to jobs data alone, there's it's such a lagging variable, and people put so much stock into it. I mean, which I guess you have to because it drives ultimately drives what the Fed's doing with rates. But yeah, the number I so I'm just trying to go through the numbers really quick. So it looks like the November added 64,000 versus the estimate was for a gain of 50,000, and then it was October fell by 105,000 versus estimates for a small decline. So, October looking pretty weak, but then a decent bounce back in November. And yeah, I know I was trying to think heading into this, like what's the Goldilocks number for the market, and it's definitely one that's not too hot, not too cold, because you want to see not too hot to keep the expectation for rate cuts alive. You don't want to see the sudden Fed pivot toward tightening policy if the jobs market was looking better, and you still, we'll see where now all eyes are going to be on CPI, but we still have consumer inflation at 3%. So, but that jobs number, I was going to say 25 to 50,000 is kind of your Goldilocks zone, to where it's not too strong to take away the outlook for cuts, but not bad enough that all of a sudden it's like, all right, the economy's hit stall speed, and now you've got a potential recession scenario and earnings impact. So, but who knows? What do they say? Trade what you should trade is the reaction to the reaction. Right now, the reaction is positive, right?
Right now, the reaction is positive. I'm going to take it to the futures market, because I thought last night was extremely uh, interesting, and I think if you're leaning long, it was like a perfect kind of setup. So here's I believe I shared some of this chart yesterday. This is a continuation of the chart. As you can see, all of November extremely choppy. I have my volume profile spitting out some key levels, which were pretty right on. In terms of the high yesterday, you had the point of control get taken out, a little bit of support here at the low value area, and then last night the market just drops overnight right to this green line. And what that green line is both your 21 and 58 simple move average. That's what that green
Hey,
line is. That's where the market dropped last night
hey, Eric.
uh,
Well, while you're on that
during the
chart,
future session.
hey,
And you could see, yeah,
while you're on that chart, would you explain those green bars, that volume profile, just kind of
go ahead.
what that is and how you might use that in your own trading?
Yeah, so I use this. I never look at price by itself. I look at price with volume in this fashion, and what it does it's volume according to the price. So it tells me at what price level, you know, what was the volume at each price level. And what these bars here on the side are telling you is where there's a lot of volume, like what price level had the most volume. And that is usually an area where the market will either bounce off of, we'll use that as a springboard, or we'll consolidate around that level, or use that as a resistance. So these are pivot levels. So instead of drawing line chart, which is I think not really scientific, I use the volume profile, which gives me these levels. And I'll throw in something else about these levels. I've done a lot of quantitative work with the team that I was with a few years back. Signal we had. And so overnight we dropped right to this green line support. You know, it is kind of like back to break even from yesterday. Flat day over day. We have a whole trading day left ahead.
Yeah, so I'm just kind of watching. Thing I'm watching is how rate cut odds are moving after this, and it looks like January odds for a cut in January are rising just a little bit. Looks like they're still pricing two cuts total in 2026 after the jobs data. I know retail sales came out as well. I haven't seen what that number was yet, but yeah, I mean, at least for right now, a lot of what the market's going to do. And if you need proof of this, I mean, just go look at what the S&P 500 did from late October into November. The S&P, at least on an intraday basis, had a 5% pullback, and that happened right alongside falling odds for a December cut. And then you had, right around Thanksgiving, a couple key Fed officials coming out voicing support for a cut, so that kind of locked in odds. Odds went the other way, and the market rebounded. So it's just the market right now is trading in lockstep with those odds for rate cuts, and right now how those odds are shifting is supporting at least this positive reaction we've seen so far. You're seeing odds for January come up, and you're seeing two cuts in total being priced in, which is one more cut than what the Fed was saying in their most recent meeting with their summary of economic projections.
So they're pricing in more. The market is getting ready for more.
They're pricing in two, which was so. One thing that's interesting to watch it's quarterly. The Fed comes out with their summary of economic projections, and so basically they call it the dot plot. So if anyone referred to the dot plot, that's what they're talking about. It plots out all the 19 Fed officials that attend the meeting. 12 of them vote, but 19 attend the meeting, and it plots out where everyone sees things ending, in the years ahead. So it could be inflation, it could be unemployment, economic growth, but then the level of the Fed funds rate too. And what you've been seeing recently is more and more dissent coming into the Fed. So I saw this something from the Wall Street Journal that plotted out, if you look at ever since Powell's been the Fed chair since 2018, if you look at where the December meeting, where all those 19 officials expect the Fed funds rate to be at the end of the year, it was always a unanimous decision. So from 2018 to 2023, that dot plot, it was just this thin line where everyone had the same forecast, the same estimate. 2024, you start to see a little bit of dissent. This year, 7 members, it's all
like
over the place. Yeah, so this is where you really need to watch what the market is starting to price versus where this dot plot is shifting to. And so there's a small divergence right now. So the dot plot's saying one cut next year, but again, those odds are that those views are starting to shift all over the place. The market right now is pricing two, and the market was pricing two into that jobs report. The market's still pricing two right now, and so if that's what you need to watch. If those market odds start to shift away from that, if it starts to go above two, that the market's going to like that. If it starts to adjust toward what the Fed's seeing right now on that median dot, that's where you start to see the pressure come in my opinion.
Yeah, the new Fed chair is coming in the middle of next year. Uh, who's gonna be a Trump guy? But then again, Powell was a Trump guy, right? And I'm looking at the yield curve since the October Fed meeting. Powell said, the December cut is not in the bag. Obviously, we wound up getting the cut, but all throughout since that Fed meeting, I've been seeing that yield curve continue to go up and up and up, and that's usually associated with either higher inflation expectations and higher economic growth, or the market is pricing in more rate cuts than everyone thinks. So I don't know. I'm kind of leaning towards more rate cuts, and I think maybe we get that as economic data potentially starts to um, deteriorate around end of the first quarter of 2026. So that's kind of a scenario, a potential scenario in play for me. I'm looking at the jobs number right now, just drilling down and uh, just line item by line item. Construction hiring, once again, leading the pack. And that's construction of buildings, residential building construction, non-residential building construction. I've been eyeing the home builder sector, and that thing has really been hit hard. Everybody has the same opinion on it. All of a sudden, in the last 2-3 months, you're seeing a lot of hiring in that sector. So maybe a leading indicator. What do you think?
Yeah, I mean, I've been it's been a while since I checked in on them, but I loosely follow home building stocks because a lot of times those can be a leading indicator. If you want, I mean, so if there's one, if you go back to 2008 or heading into 2008, home builders peaked in 2005. So you had a market peaked in '07, so you had a 2-year advance warning. While home builders peaked in 2024, I think it was October 2024, I believe, and they have yet to see that peak. So I mean, so there's two aspects to it. There's the really short term trading angle on home builders and how they might be bouncing around with the economic and the rate outlook. But then also a bigger picture macro perspective is I think it's interesting that home co-builders are remain well off their prior record highs, which was a warning sign you had heading into '08.
Yeah, retailers also picked up in job hiring. So I don't know, home builders plus retail maybe equals Home Depot as a long, So
Have you
right,
seen? I haven't seen it yet. Have you seen the what the household survey was?
no,
I can't find it. So one other thing to look at when you're looking through the payrolls report, like you always see two numbers quoted, right? You see what the jobs number actually was, and then you see the unemployment rate. So we had a better than expected jobs number, but the unemployment rate still ticked up to 4.6%, which was the highest the unemployment rate has been since 2021. But the unemployment rate is not calculated off that payrolls figure you see in the news. What it's actually calculated off, there's another survey within the jobs report called the household survey, um, and that's the one that drives the unemployment rate. I'm trying to find what that number was since the unemployment rate ticked up. And sometimes you can get some really big discrepancies between what the headline payrolls figure is, and then what the household survey is. And the payrolls figure comes from businesses.
That's all right. So 4.6. So you're saying the unemployment rate is derived from that from
The
that data?
unemployment rate comes from the household survey, not the number you see quoted all over the place.
So it's at 4.6% unemployment rate. What is the long term average for the unemployment rate? I'm just wondering. Is it around like 6.5? Is that where it's at?
I don't know the long term averages, but I know we've been steadily moving higher on the unemployment rate. Right now, it's the highest I think it's since November 2021. It's still so the way you look at it is it's still near the historic low end of the range, but for several. One other point I would make around, you're talking about the yield curve. I'm writing up some research for Larry's e-letter that we're going to send out over the break, but it goes back and looks at, how the yield curve tends to move around recession dates, because what ends up happening is when the yield curve goes inverted, that means the Fed's tighten policy and they've pushed short-term rates above long-term rates. All right. And that's where everyone freaks out because they say, inverted yield curve, recession signal. Well, the yield curve inverted back in 2022, and we've not seen anything since then. But when you go back and look, it's when the yield curve uninverts that the clock starts to tick on
Right.
70. Because you think about what the moving pieces are, usually the yield curve uninverts because the Fed's lowering on the short end because they're concerned about the economy, but the Fed's always too late to do anything. And we'll see, it seems like Powell's been calling these risk management cuts. We'll see if maybe they actually got ahead of the curve this time and, are stemming off further weakness that we've seen in some of the labor market data. But, it is interesting to watch that unemployment number month after month keep ticking a little bit higher, knowing in the back of your mind that the yield curve uninverts and steepens ahead of a recession.
So when that yield curve inverted, uh, what was it, like 2 years ago, 2.5 years ago, for that first time it inverted? I think it was the longest time on record where we had an inverted curve without a recession, and it is uninverted a while ago and still no recession. So why do you think that is? Why, these are traditional indicators, and you hear Larry and I talking about it all the time. Larry's always looking for a clue. And what those clues are in trading is, okay, rates are up, stocks are down. Rates up, that means gold needs to drop. These are traditional kind of low Sharpe ratio indicators that kind of work, but all of them have been kind of, I feel like, thrown out the window. And I think the best example is that relationship that you just talked about, where you have an inverted yield curve uninvert, which usually means 9 out of 10 times that's a recession, and we just haven't had it at all. So,
Yeah. So
why do you
this
think
is
that is?
so I've got the yield curve up on screen right now, and what the blue line on here tracks, it's taking the 10-year Treasury yield minus the 3 month. So I use the 3 month because the 3 month is going to track very, very closely where Fed funds is at. And so the relationship we're talking about here is when the Fed pushes rates really high when they're tightening policy, they tend to push rates above where the 10 years at. And so this line drops below zero. So that's the inverted yield curve. And that's what gets everyone's attention because you can see when this is going. So in 1989, ahead of the recession in the early 90s, ahead of the recession in early 2000s, ahead of 2008, no one knew the pandemic was coming, but you had the yield curve inverting before that recession, and then again, and this was in October 2022 is when it first went inverted. But when you look back, it's the yield curve inverts, but it goes back to positive territory before each one of those recessions hits. And I don't know why my chart's getting cut off on the screen, but if you were to extend this out to the right further, you would see this yield curve is now back in positive territory. So I'll put my mouse where it's at right now. The yield curve currently is right about that level where my mouse is at. So that's the uninversion that's taking place, and the uninversion usually happens because now the Fed, by this point, take 2008 for example, things were starting to get bad enough that the Fed's like, oh crap, we got to start to cut rates because the economy is deteriorating, but they're too late. They rush to cut. They bring the short-term rates back below long-term rates, and the yield curve uninverts, goes back into positive territory. But by then, it's too late. And I think you need to have that scenario in the back of your mind as we've seen, some numbers deteriorating, but as we've had that unemployment rate just kind of steadily ticking higher for the last several months.
Yeah, I think it's bad. I think this is why economics is not really a science, right? It's a pseudo. It's a pseudo science. I mean, this is things like change all the time, and you have new types of different types of data, and it could it's such a touch and feel kind of industry. I've always found that pretty interesting. We're getting questions about the range that I expect throughout the day. So I mentioned, look, uh, I showed the overnight lows, and there was quite a bit of volume that created that support down there, right around that 50 and 21-day moving average. That's about 35 to 40 points lower from where we currently are. The straddle coincides with that. The straddle's trading at around 37 right now. So that could be, I think if we go through that today, markets kind of markets got an issue. I mean, these levels on a you call it Goldilocks. Maybe we had a Goldilocks kind of data report out today. Um, so I think that should hold. The puts down there are kind of bid. 67.70s are trading at $8, which is pretty high, I think. So it feels like the market is not sure. Uh, Looking into the Tate pre-market, you got a pretty good mixed bag. Mag sevens are mixed. Everything's kind of mixed. So it's too early to tell. Usually, if everything's mixed by within the first half hour of the day, it's usually a good time for kind of start thinking about range bound trading, which means iron condor. Maybe an
I
iron
knew
condor kind of day, man.
I knew it was
Once
coming.
again,
I
you
knew it was
knew it was
coming.
coming, right?
What do you think about? So
Uh,
one
the,
thing I've been watching lately is with the mag set, like you've got Nvidia's trading near 3 month lows. You had Oracle's just been getting clobbered recently. Broadcom, same thing. Microsoft. I mean, all these big Max 7 names are trading relatively weaker, but the average stock's holding up pretty well. Like if you look at the RSP is the ETF that tracks the equal weight S&P 500, it's making new highs over the last week or so.
yeah,
Versus, I think that's
Evans, no,
yeah. I mean, it's just these guys all of a sudden. I mean, the foundation of the bull market has turned into laggards. I mean, it's very short term, but the names leveraged to the AI and growth trade are struggling recently, and I'm not sure what's the catalyst behind it.
I think the whole market's been pretty strange like that recently. Here's a chart I was looking at yesterday, um, and this is top panel. You have the Mag 7 VIX, which you could see has been dropping and falling, and it's pretty low, right? At the same time, you have the Mag 7 index in the middle here, the red line, as you said, falling. And then you have the rest of the 493 stocks holding up. So I'm actually looking at this in a bullish way because the market is less myopic. And I love when the market gets less myopic because that means the market gets less stupid. Like if everybody's piling in to the same seven stocks, I don't think that's. I think that's telling you um, all the growth. There's no growth outside of the Mag 7, and everybody has to pile into the same names to chase that growth. When you have a broadening out of market breadth, it's like the most bullish thing ever because now the market is thinking, hey, there's growth. I could go shopping for growth everywhere. And so I get excited when there's a rotation out of, the leader and into stuff like Homebuilders, XRT, the retailers. When I see Home Depot off its lows, when I see healthcare kind of ripping. And in November, I think there was a fiscal year end for a lot of the mutual funds. And that's when I think this kind of rotation really kickstarted. So I think the market's been trading weird, like you said, because I just see this ongoing rotation for taking place that really I think started when mutual funds had their fiscal year end.
Yeah, that would make sense. And yeah, I wondered if how much year end rebalancing, getting out of some of those names if you've been in those winners for a long time is potentially coming into play. I would add, one. Yeah, I agree. I mean, I think that type of rotation is bullish, but it's also why as at least as an investor, you really need to be looking under the hood and paying attention to these trends because you could see that discrepancy easily continue because the mag set like the top 10 of the S&P 500 is like 42% of the index. So those names are clearly weighing on the S&P. It's why the S&P hasn't made a new high while you've got things like RSP making a new high. Or what I would recommend is tracking if you want to watch breadth, watch the NYSE's advanced decline stats. So on any given day, you can track the advanced decline ratio on the NYSE. But then you can also take that daily net difference and turn it into a cumulative sum as just another way to track the average stock. And that line last week was making a new all-time high. So that line had peaked out sometime in September. That line and then just was grinding sideways. That line over the last week or so is now making a new record high, which while the S&P is pulling back. So if you're if you've been conditioned to buy and hold SPY or QQQ, you really need to start looking outside of some of those ETFs and figure out what's working, what isn't working. Some trades that I like right here are more on the commodity side. I know we've talked about commodities a lot, but there's been a pullback in both oil and the nat gas space that's taking those to some interesting levels where I think you can
Yeah.
position for a rebound. I mean, natural gas had a huge rally, was way overextended, has been mean reverting lower. Now it's retraced a portion of that prior uptrend. It's holding above a 50% retracement, but now it's trading. It got right down to the 50-day moving average. So good support level right there.
To kind of crystallize where commodities are at, an ounce of silver is now worth more than a barrel of oil.
I saw that
So
yesterday.
you saw that? I thought
Yeah,
that was so cool. I think that's what commodities are this year. I think it's all been metals, and silver's been front and center lately. And like the rest of these commodities, like you said, like crude energy has been, you know, you it's been a dog this year. And I think unless we get oil up, unless oil starts to really rally, I can't. I struggle to see how we're going to see these big upticks in CPI, unless unless of course the dollar collapses because of some unforeseen de-dollarization scenario next year. But I wanted to get back to that rotation conversation. I find it very interesting. I think it's very I think it's very important for people like looking for a clue in the market to track rotation and what sectors are doing well and how stuff is performing within the sector. Are investors gravitating towards high risk or low risk? So when we're talking about the Mag 7, people pulling out of the Mag 7, usually you would think that's very bearish. But low volatility as a factor has not been doing well, which is very bullish. So again, that this is the low volatility factor within the S&P, which is tracking your least volatile stocks. So this as a strategy has not been doing well at all over the last few weeks, even though you've been pulling out of the Mag 7s, aside from Tesla, which has been doing extremely well. But you see, this has been on a decline. And so, where's the rotation coming from? Just to crystallize the point, it's been in value. This blue line right there. That's where the market is piling into. So again, this is when I say a bullish rotation out of the Mag 7. This is what it looks like. It's when investors are piling into value, but at the same time, they're not piling into low risk value. They're piling into high risk value and selling off the low volatility trade, which is exactly what you're seeing right here.
It's interesting. You say they're
That's how I
selling.
look at it.
Yeah, if they're selling off the low volatility trade, what I've seen, what I saw yesterday is you had a lot of, I'll call it speculative growth names, whether it's Bitcoin miners or some of these quantum computing names. They're all
Rigetti.
starting to break. They're all starting. Yeah, well, pull. I don't know if you have a chart on it, but they're all starting to break down from bearish flag patterns. So, they were mean reverting lower off that big move they had. We saw a counter trend rally higher over the last several days or weeks, and just yesterday, a lot of these things were breaking down out of their patterns. Like you can see it with Rigetti RGTI, maybe ticker Mara MARA. There's
Yeah.
several of them
Crypto.
that are
Yeah.
that.
Yeah.
So I don't know that like that trade. That was a fun trade for a while back into October, and then those names have just collapsed. And it looks like they want to go on the next leg of their downtrend, next leg of the decline right here.
Yeah, I mean, investors seem much more sober than they were earlier in the year. And so they're not buying up this BS. Quantum compute. I mean, I keep on saying where the bubble was in some of these names that you mentioned, like Rigetti. I'm still shorted. I have, I'm thinking $17 should be a good spot for Rigetti, maybe even 10. I mean, I don't even understand the justification for even $10 a share at this point in its life cycle. So yeah, I mean, would you call these high beta names or would you call these just pure hype names?
Both. I mean, you
There's
one
a
one
there's a
thing.
no, it's a fine line there because beta is like okay, beta is going to track the market, and then when we say beta, that means the market high beta would be it'll follow the market in a much louder fashion. But this hype stuff, I think it's idiosyncratic, like an idiosyncratic little bubble within the market.
Yeah, I agree with that. I mean, you had that with the quantum computing names. You didn't really see that in a ton of other sectors. Maybe, I would say the high beta, the real spec stuff that was working over the summer and early fall was concentrated in the quantum computing and the space sector as well. If you look at, I think you've talked about who was it, ASTS before. I've traded Rocket
Well,
Lab before. Like
that's not
those.
hype. Love that is not a hype stock. AST
That not a hype
stays.
stock. So the
Nah,
narrative's changing. You're changing the narrative
no,
behind the hype stocks. Is that what I'm hearing?
that's not a hype stock. You guys have mislabeled AST as a hype stock.
All right. Well, I'll keep that receipt. We'll come back to it later. But
All right.
but yeah, no, I think. Look, the one thing you need for all these stocks to work are bullish liquidity conditions. Like you need when all these things started to reverse lower is again when that Fed rate outlook started to shift, and they haven't been able to recover, which I'm kind of surprised at because you had another cut, but now you had the Fed also announced they're doing. They won't call it quantitative easing, but they're expanding the balance sheet again to the tune of $40 billion a month. They're doing this with financial conditions are already really loose, and one thing that a lot of people are overlooking heading into next year is that this one big beautiful bill is supposed to be very stimulative. It's supposed to add 1% to GDP. So, it feels like you've got the
That's right.
right you got the right conditions in place to see some of these really high beta speculative growth names perform, but they haven't been able to find any traction yet, and that surprises me a little bit. Also surprises me that the Mag 7's pulling back with those conditions in place potentially, but that just shows how things are shifting under the hood, and you gotta price is what ultimately pays, right? I mean, you got to watch the price trends of these things.
So the big beautiful. I'm glad you mentioned that. The big beautiful bill. When is that going to kick in? And when do you think that's actually going to start affecting the economy?
Well, I don't know how much it has to do with this, but I know refunds are projected to jump big time next year. So, from a timing standpoint, that could be one thing. Overall, I mean, there's several tax provisions in there, whether it's larger deductions for overtime pay, a larger standard deduction. There's uh, helps me and you out. The child tax credit is increased. So several of those things go into effect, and then I know there's some shifting going around the spending programs, but the all in the CBO, the Congressional Budget Office that kind of grades these things, they're saying it's going to add 0.9% to real GDP in 2026.
So that's going to be additive, right? Now, do you believe that AI, the CapEx spending, is going to slow down as you're seeing stock investors get a little bit more sober with the Mag Sevens? Do you think CapEx spending is going to get more sober, a
I
sobering
think,
out of cap?
yeah, I think you're going to continue to see high levels of capex spending, but I think you're going to see the rate of change start to slow. And for a lot of things, stock prices respond to the rate of change. So if you start to see a decelerating annualized growth rate of capex spending come in, I think that starts because look, I mean, these names, so many of these names have had a huge run. That huge run is based on the outlook for this stuff to keep going. And if that, if that acceleration, if it starts to come in some, then that, in my opinion, that's going to weigh on these stocks. I mean, just like it always has. I mean, it's if you want to see what really matters for
Right.
the market, it's track the rate of change and some of these growth indicators. But same thing goes with capex spending. I think if you start to see um, the growth start to moderate and these things are priced for perfection, that's where that weighs on price, and maybe that's what's behind some of the recent weakness in the Mag 7 names.
So right. So I would say 2025's GDP was really held up by capex from AI. Would you agree? I think without that boost,
I
maybe
had
we would have.
Yeah, I shared a stat when we were together in Florida that some economists did a study on it only covered the first half of 2025, but the first half of 2025's GDP growth was 92% of it was attributable to AI CapEx spending. It was data center CapEx spending. Something that makes up 4% of the economy drove 92% of the GDP growth.
Exactly. So if that slows down, I'm not sure if the big beautiful bill is going to make up that difference. So this is why I'm kind of bracing for that. I think next year, and I was actually surprised to see some big bulls out there kind of bracing for next year. But I think we're gonna get. I think there's gonna be a point in the first half of the year. I think it's gonna be probably around the end of the first quarter, beginning of the second, somewhere around there, where we see like serious turbulence. So I don't know if the big beautiful bill, and I think somebody mentioned the tariff rebate checks for $2,000 on the chat. I don't even know if that's a real number, because if you add up all the $2,000 checks they want to send, maybe that's even more than what we've collected in tariffs in total. So I'm not even sure if that's a feasible number, but
Yeah, I don't know the number. I don't know. Yeah, the numbers being thrown around if they're made up or not. But I think one thing I would say of
yeah,
all
maybe
the
carrot and stick. Maybe it's like the carrot Trump is dangling, or
I think
over
no matter
for the
what you look
midterms.
at, no matter what you look at, I think the one thing it all is it's inflationary. So continue to watch for if inflation keeps inflecting higher in the next year, because I think that's where the Fed and the stock market would really get into trouble, is if the economy is holding up okay, but then you really start to see inflation take off. That would be a really big deal. The other around that point, two things I would watch. I need to look into this number further, because I just saw this last night. I was doing a little bit of reading and research around U.S. debt. 34% of all U.S. Treasury debt outstanding matures next year. 34% matures next year and has to be refinanced. So that's a big number. And so I mean that's why, obviously why there's so much political pressure to lower rates. I don't know, of that debt coming due, like what the term structure looks like that it needs to be refinanced at. If it's a lot of short term stuff, longer term stuff, or whatever the case may be. But that's something to watch next year. And then around, if you want to see if concerns around kind of the fiscal the fiscal well being of the U.S. government, I would watch the U.S. dollar index. So watch DXY. I mean, it's had some attention this year, and obviously it's a big catalyst behind the move you've seen in gold and silver. But I think if the dollar index, and I'm gonna do actually a recording on this to post on the show when we're out for the holidays. But if the dollar index it's been weakening recently. If it takes out the lows from this year, which is around the 96 level, I think that's a major warning on kind of shifting views in the market on the health of the U.S. government's fiscal situation.
Okay, so it's 9:15. Markets are opening up soon. Um, what do you guys have on tap for quad witching? If you want to
We
update the
so
crowd.
Yeah, so we added a call yesterday that expires on Friday. We did that a little later in the morning after we had a pullback from the open, and then the market was just kind of grinding sideways since then. So we're watching that trade. We've had a really 2025 all in shaped up to be a really good, really strong year for us. We had one ticker trader I think's had its best year since uh, Larry launched that trading service. Opportunistic Trader is up on the year. Currency Wizard, we closed out our long euro position last week for a gain. That puts Currency Wizard up on the year. And then we had a really strong finish to the year in S&P Trader. So if you kind of look at a tale of two halves for some of these products, like the volatility that we had in the first half of the year really helped. We had a lot of great trades in one ticker trader and opportunistic trader. But then in the second half of the year, especially this quarter, we went on a really good run in S&P Trader and finish, on closed trades basis, we look to finish out the year positive on all of Larry's products.
Yeah, if you think about just you kind of step back into, you guys have four products, and the way that I look at it is I look at it from like an allocator's point of view. Like each one of these is, let's say, a hedge fund strategy. You have a strategy that is buying premium, and that's very difficult to constantly buy premium is a difficult way to make money, but it's a great way to get big gains. And then you have another product that is constantly selling premium. And by constantly doing that together, you're buying premium and selling premium. I always look at it like you're normalizing out a lot of the decay in the option, which weighs down on your P&L
Yeah.
through the selling. Um, and it's a good combination. You have the SPX overlay around directional bets. And I think what that does over time is smooths out your P&L. Like you mentioned, first half of the year, great for being long premium because volatility kept going up and you had
Right.
massive moves. But that kills your credit spread sometimes. And then as the market normalizes, you want to be selling premium constantly, which is the SPX trader. So, yeah, uh, use both, people. Use both, right?
That's right. Yeah, like you said, they're very, everything kind of works together and is very complementary, but uncorrelated too at the same time. And the thing that I think it shows you is that these are great strategies for when things get volatile. And I think we're going to see, a lot of what happened in terms of market action in the first half of this year. I think you're going to see a lot of that next year. You've got a lot of really key macro themes that are going to be kind of colliding together, and to the extent that is going to impact rising volatility, there's a number of ways that we can take advantage of that, and that's been, Larry's proven that time and again in his track record. I mean, if you go back and look at the last time we had a bear market in 2022, every single one of Larry's products at that time finished positive for the year. So these are great strategies to have as call it, whether it's a hedge or something that's non-correlated with kind of your traditional long holdings, buy and hold. Like this is a way you can add uncorrelated alpha to your overall investment portfolio.
Um, yeah, a little bit of pushback from the chat in terms of opportunistic trader, but like as you said, the first half of the year was good. Since then, maybe not as good. One thing that I would recommend for subscribers, and I'm not part of the opportunistic trader, but what I have, and for people watching, right, that uh, there's a frustration sometimes, and I think the more I talk to subscribers and the more I understand how they use these services, the more I understand it's not all about the guru. It's about you yourselves, the subscribers, and how you use the service. So one thing to look out for is when the trader goes on a hot streak. Do you go from 10 contracts to 100 contracts? Because you're like, okay, this guy's can't miss. I'm going to do 100 contracts. And the other question is if you're using both services, the way that I would recommend, and maybe Larry has something different, or maybe you, Clint, have a different suggestion. But the way I would do it is to keep the contracts even, because the way Larry's looking at it, and I know the way that you guys keep your P&L, is you're tracking points,
Yeah.
right? You're tracking how much premium is coming in, how much premium is coming out. So if you do 50 contracts of an NVIDIA put option, but only do 10 contracts of an SPX spread, right? And you lose $2 on NVIDIA, but you make $10, but you make $2 on SPX, your P&L is going to be net down. Whereas it shouldn't have been if you kept the contracts even. So I would suggest, thank you, Peter. Peter's like, you are right, Eric. Yes, this is, I know, because this is, I've talked to a lot of subscribers, and I know how they, you got to get that, you have to just kind of keep everything even, let it play its course. Don't, if, and if the trader gets a little cold, don't lose hope, right? He's probably going to come back,
Yeah,
right?
yeah,
So
well,
don't.
just to put a disclaimer behind my comments. Yeah, my referencing performance is the result of trading one contract in each service throughout the year. And just to my so like guidelines on what you're saying. Yeah, you don't go from trading, deciding to trade one contract now. Next week I'm going to trade 10. Like you want to trade you want a position size relative to your capital. Like you got to figure out of your total pool of capital, how much capital you want to put at risk, but then you stay consistent with that. And as your total pool of capital grows, then you can increase your position sizing along the way. So you don't jump around. I mean, it's very incremental, it's very intentional relative to, again, your total account size and how much you're deciding to put at risk there.
Exactly. All right. I think we're going to wrap it up for today. That's it. Thank you, Clint. It was a pleasure as always. Good to see you last week. Hope I see you again soon. That was that. It was funny in the conference that we were at. There was a point where somebody was like, "Nvidia's gonna go up to like 700 before it crashes," or something like that, something crazy like that. And just watching Larry's reaction on stage was pretty funny. I don't know if you caught that, but I thought it was pretty amusing.
I couldn't see his
Uh,
face. I was sitting next to him. I couldn't see his face.
it was a spectacular sight. I'll just leave it at that. All right. Hope everyone makes a ton of money today. Markets are at a standstill. So maybe Iron Condor. I don't know. Let's see how it works. We'll see you again tomorrow. Thank you for joining us.